Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking a look at another undervalued potential turnaround play. And this is the Buckle Incorporated, ticker BKE. This is a Western clothing retailer. I personally don't shop there, but I have seen them. I've heard a lot of people shop there. So when I saw their special dividend, I wanted to dive deeper. In the past, I looked into it. I thought it was a decent company. It's not looking bad from what I'm seeing. So we're coming up with a low of about 51.5, fair value around 60.5, and a high would be close to 67. In the last 52 weeks, we've seen it go as low as 28.5. It's currently sitting at just shy of 40, and it's been as high as 45. So even the peak here is lower than the low range that we'd be looking for to buy, which is ideal for a value. Earnings yield is great. We want double digits, 11.4%. They just need to make $1.98 in earnings per share to get to what we're looking for. And last year they came at $4.61. This year they're projected to do $4.25, and in 2025, $3.90. And that's where things start looking interesting. They've been growing double digits over the past few years with their revenues, and analysts are expecting some single-digit declines over the next 2 years. If you disagree with analysts, it would definitely be worth taking a look at buying some. If you agree with them, it's still not a bad deal, and we'll take a look at that. Cash flows, 15.76, traditionally 19.11. They were down a little bit. Revenues were down. Cash flows, in fact, were higher than last year. They have been on a decline since 2021. 2022 was a pretty low year compared to everything else. Dividend, they pay a crazy special dividend. That's what's propping up this payout ratio and this yield. It's not necessary. If they're doing it, clearly they have the money to do it. Their actual dividend is definitely safe, 35 cents a quarter. ROE, ROI, and ROA are all very good, nice and high. So that brings into question debt. Where did they stand on debt? Because that could inflate these numbers. And it's not bad. They've been improving it over the last few years, getting a whole lot better, bringing it down a little over 3% a year. And they finally brought their debt to equity ratio down below 1. And that's really the point that we would look at really starting to buy. So their balance sheet is becoming a whole lot better. Gross margins, 50.25, up from what they've traditionally been, 46.7. Net margins, right around 19%, up from the 16 that we've seen previously. We've already touched on this revenue growth. Earnings per share, similar situation here, huge double-digit growth over the last 2 years. And analysts are expecting declines of nearly double digits over the next 2. Cash flow is a little all over the place. Like we saw, at least their revenues were down this last year, but their cash flow was up a little bit. So they were at least able to hold that stable. Share count, they are issuing shares, which is a red flag. We don't really like that. It's a small amount. They seem to be using the investment pretty wisely, though, because they do have really good returns. So it might be something that we can ignore. Definitely keep it in mind, but it's not they're raising shares. It can't be touched. Assets, they stopped shrinking and started growing them over the more recent years. And liabilities, the other way around. They were growing them and started shrinking them. So clearly they've gotten better over the last 2 years than they were previously. Dividend growth has been major. I don't expect it to go much further. I think that it basically held over the last year. We might be expecting the same going forward. So if we disagree with analysts, we say that they're going to continue with their double-digit revenue growth, 12%, even lower than they did at any point in the last 3 years. Shares continue at 0.5%. Cash flow stagnant. Assets up a tad. Liabilities down a bit. Dividend stagnant. Margin, a bit of growth. We'd be looking at a fair value in 3 years of $76, which is 132% higher than the stock sits today. And in 5 years, 95.11, 206% higher. So it would definitely beat out the markets, that 8 to 10% that we traditionally see in the S&P. And that's definitely got me interested. there's no major red flags that I'm seeing across anything aside from the fact that analysts are expecting declines in the near future. And so with those numbers, we'd be looking at a 10.45%. That's pretty good. That is a market-beating return. But if these revenues dip down more towards what the analysts are expecting for the company, a dip of, let's say, 3.5%, kind of in between what they're giving over the next few years. And then let's say that the cash, well, looking at that, we're still up. In 3 years, the share price would be $60.32. You double your position based on fair value if you bought in today and you collect dividends along the way. Over the course of 5 years, even better, 115%, but your average return is negative 2%. And that's why I say this is a turnaround play. They need to outperform what analysts are expecting for them to be reasonable. I wouldn't want to invest into a stock with a negative average return, but if they're able to come in with something flat and be undervalued, if not a little bit of growth, even if they can hold revenue stagnant, it'd be something I'd be more interested in. You'd essentially double the fair value of your position over the course of 3 years, or based on today's prices. If we want to see how things are trending here, earnings are kind of all over the place. They've definitely jumped a lot from 2020. Cash flows are a similar story all over the place. They're lower than they were back in 2020, kind of peaked in 2021. Like we said, last year was a low, or 2022 was a low year. 2023 was a bit more of what we'd like to see. Balance sheet, great growth here. Really low back in 2021, and they have been improving year after year since then. And then dividend, they had massive yields previously, so that's why that special dividend really is factoring that. That's why this is much lower weighting than some of the other portions of the sheet here. Everything graph, we want to make sure that this is all going up to the left, and essentially it is. The fair value is sitting right above the share price. There's kind of a gap in between valuation metrics, and the two of them sit pretty well between them. And the cash flows are just beating out everything up here. And those cash flows can help with that balance sheet, which has been improving since 2021 here. And that dividend, with good cash flows that can pay out a good dividend, even though it's not a major factor for a quality stock. Those returns, the ROA, the ROE, their assets are making very nice returns. Their investments are making nice returns. And their debt is at a low enough point where they now have more equity than they have debt. So it's something I'm interested in. I'll keep an eye on it. With the dividends that they pay, I don't think that it'd be a terrible small dividend position and then a potential turnaround play. We'd have to see how things play out over the course of the year with their earnings. And that's all for this one. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.